That's good.
I used to teach it. And then
She was like pretty much all the exams.
Oh my god. What a waste of time. Like,
oh my gosh. No, I did not. After 2 sessions, because after hearing about it, also it's
Okay, well, you had a good weekend.
we're gonna visit.
Wanted to make sure you were aware, our friends at Bait Office, I have a presentation on Wednesday. It's about public speaking. If you don't know already, I'm a big proponent of it. This is a person from the Writing Center that's talking about proven tips and techniques to prepare, practice, and confidently deliver an oral presentation. So, I do think, just to reiterate, this is an area that is a practiced behavior. You can get better at it. The more you do it, I promise, the better you will get at it. This is the time to do it, where it's nice and safe and environment. So, hearing this individual and their perspective on this would probably be very helpful for you. And again, if this is something that you have some unease at, that may be an indication of something you need to spend a little time on. I like to think of every professional has things they do really well and things they need to work on. Just think if you could spend some time over the next few years working on the areas that you're less comfortable on. You don't have to be the best, but just move it upward. Think how easier your professional life is going to be to take that off the table. So this would be time well spent if you want to listen to that on Wednesday afternoon. Okay, we are going to continue with Chapter 8. We are around slide 32. So we're going to continue on with transfers to a corporation and corporate level tax consequences. There's a couple additional basis rules, right? We can do the transfers to the corporation on a non-taxable basis. We do know we have tax that will be incurred if there is boot involved in the transaction, so the shareholder does not just receive stock in the corporation to which they're transferring assets, and that will cause them to recognize some gain, but some gain would be deferred if they receive stock. There are 2 additional basis rules that we're going to go through to start. Then we're going to start in with acquisitions and corporate acquisitions, and we're going to start with taxable acquisitions, and we'll do taxable acquisitions of stock, taxable acquisitions of assets. And we may stop there today, or we may go a little bit further. Where we left on Wednesday was the example whereby we had some boot in the transaction. So remember, there was $60,000 of cash that was received by the shareholder. That caused the shareholder to recognize some gain summing to $60,000 across 3 assets. Okay. Now, what happened then is the basis that the corporation takes in the assets is carryover basis in the assets. So the assets come from the shareholder into the corporation. So you take the basis the shareholder has in the assets, that comes over. That's your starting point, the carryover basis. But the gain recognized in this calculation in the yellow, the corporation gets to increase their basis in the assets by the gain that the shareholder recognizes. So that's the gain recognized. So we get to actually increase our adjusted basis from collective 175 to a collective 235 for the $60,000 of gain recognized by the corporation. Remember, when somebody recognizes gain in a transaction, somebody gets tax basis because the government has collected that appreciation value, the tax on that appreciation. So, the first rule we're going to talk about is what happens to subsequent depreciation, right? Corporation's going to get the assets, they're going to use them in their trade or business. So how are they going to use, or how are they going to set those new assets up on their depreciation calculations? And so we have 2 components to that. Components at the bottom of this example. So the carryover tax basis portion of each asset. To the extent that basis carries over from the shareholder to the recipient corporation, the corporation just steps into the shoes of the shareholder and just continues depreciating the asset using the shareholder's depreciation schedule. So nothing changes, right? Nothing changed from a taxability standpoint when we contributed the assets from the shareholder to the corporation. So the corporation has the same basis in the assets that the shareholder has, and if it's in the middle of depreciation, you just keep on keeping on, right? You need to get that information from the shareholder, but you can't. That'll be part of the agreement between the parties, is you're gonna give me where we are in the middle of those tables, and I'm just gonna pick that up and keep going on, right? And that makes sense, because no one paid tax on that. But any portion that is new tax basis, any additional tax basis created in the contribution, so when the shareholder recognizes gain on the transfer in cases when boot is received, is treated as a new separate asset and starts a new separate depreciation schedule, right? Because there was nothing going on at the shareholder level, right? It was created upon the exchange because the shareholder had a taxable event because of the boot they received. So therefore, that portion of the gain, that new increased basis, is treated as a new asset. And everything we learned way back in that depreciation chapter, we start that again. What class life is it? What table am I on? I have year one, right? That's what I do for that new portion of the basis. Okay, let's do 814 to show how that works. This is Connor.
So for this one, recall that Al received 40 shares of 360 Air stock with a fair market value of $315K and $60K in return for his transfer of inventory, a building and land to the corporation in a qualifying 351 exchange. The cash received by Al constituted boot received and caused him to recognize $60K of gain on the transfer. 360 Air takes Al's tax basis in the property and increases it by the gain recognized by Al on the transfer. Corporation's adjusted tax basis in the three properties is as follows. 360 Air will carry over Al's holding period in the building and land transfer because they are 1231 assets. How will 360 Air compute the depreciation deduction in the building for the year of the transfer? For this problem, let's assume that transfer occurs on the 1st of January. Furthermore, let's assume that Al originally purchased the building for $67,400 in September 5 years ago and has claimed $7,400 of straight line depreciation over a 39-year recovery period using a mid-month convention.
So let me pause you there. So that's real estate, right? Building. And remember, the tables for building are a really long recovery period, 39 years, and it's straight line. You have a half in the first and half in the last year, then everything else is just claiming a little bit of straight line depreciation for an enormous amount.
So 360 Air here carries over Al's depreciation schedule for the building with respect to $60,000 in the original basis, but the company depreciates the additional $24,000 as a new asset. With respect to the carryover basis portion of the building, the company uses Al's original cost of $67,400 in the building to calculate the depreciation computation. Al is entitled to 1/2 month for depreciation on the building in the year of the transfer, which equals 72 if we do the calculations. The corporation is entitled to the remaining 11.5 months of depreciation, 1656. The corporation treats the additional $24,000 of basis as a new asset and applies the proper depreciation rate to calculate the additional depreciation. Because the transfer took place in January, the company would be entitled to 11.5 months of depreciation. Hence, 360 Air would claim additional depreciation of $591 for a total depreciation deduction of $2247.
Yeah, so I'm less interested in you knowing that they get a half a month on the date, on the year of the exchange. I just want you to understand that the carryover portion, you're basically just stepping into the shoes and keeping on the same depreciation calculation and tables wherever they are. And the new asset that was created, new basis in the asset that was created by virtue of the gain recognition, that's a new asset. You have to start brand new in the life with that. That's the key. Yep. Thank you. Okay, so the second and last topic on tax basis is in cases of built-in loss property. So everything we've been doing so far assumes that there's built-in gain in the assets. Okay? If I do a contribution of built-in gain assets to a corporation and assume no boot, right? Then I take the corporation takes a carryover basis in the assets, so the gain in the assets is preserved at the corporate level. The shareholder, remember when we talked about the shareholder's implementation, they take a substituted basis, meaning they substitute their basis in the assets for their new basis in the stock that they receive. Built-in gains preserved there. So I duplicated the built-in gain in the assets, is the way to think about it. Okay? I had built-in gain in the assets when I started. Now the corporation has that built-in gain, and now I have a built-in gain in the stock that I received in the so I had 2 layers of gain duplicated than what I had when I had one to start with. So here, the government doesn't dislike having duplicated gains. Right? They're not recognized, they're just latent in the fair market value of the asset versus the holder's tax basis on that asset. Be it stock at the shareholder level, be it assets at the corporate level. But the government dislikes having duplicated losses. If I simply applied those same rules, but I changed the fact to say the shareholder had originally a built-in loss in the assets, meaning that they paid X and their tax basis is higher than what they paid for it, right? So, I'm sorry, let me restate that. The value of the asset is X and the tax basis is higher than the value. You just paid more for the asset, right, than what it's worth. Happens a lot. Sometimes assets depreciate in value, economically depreciate in value. But your tax basis is higher than the fair market value of that asset. If I just did the rules we talked about before, I'm duplicating the loss. The corporation would take a carryover basis in the asset. They have the built-in loss. The shareholder would take a substituted basis in the stock they receive, same built-in loss in now the stock that they own. Okay? Government dislikes duplicated losses. In any of my tax classes, losses are always different. There's more limitations, there's more rules around losses than income and gains. The government is not so concerned about that. So here, the government is concerned about built-in losses and the duplication of built-in losses. So that's the rules we're going to talk about here. But I just want you to note, in the lack of symmetry there is with no concern about duplication of built-in gains. So the rules we're going to talk about are only applicable to built-in losses. So there are limitations placed on the transfer of built-in loss property in a 351 transaction to prevent a duplication of loss. Okay? Once in the property itself due to the carryover basis rules and the corporate level, and then second in the stock received due to the substituted tax basis rules. So the threshold question, don't get sidetracked on this because this will catch some people. The threshold question of whether built-in loss property is transferred is determined on an aggregate basis, meaning we look at all of the assets' fair market value and all of the tax basis in the assets we contribute. Only if we have an aggregate built-in loss do we implicate these rules. I could have 10 assets and one of them have a built-in loss, but on an aggregate basis there is no built-in loss, then we're not in these rules. And remember, when I say built-in, that just means that the unrealized loss of the property, meaning that the value is below my tax basis, but I haven't recognized it yet. When I say built-in, that just means it's latent in the asset, hasn't been realized yet. Okay, so there needs to be, we're going to be looking for an overall net built-in loss, considering all of the property contributed. Any gain recognized by the shareholders is included when considering the aggregate tax basis of the assets transferred. We just talked about it. If I do have boot involved and the shareholder recognizes some gain, that gives the corporation basis in the assets. We count that basis in determining whether we have an aggregate built-in loss. Okay. So, the general rule in cases of built-in loss property on an aggregate basis, the general rule when I have a built-in loss is the aggregate basis of the property received by the corporation cannot exceed its aggregate fair market value of the property. Meaning, our general rule is at the corporate level, the corporation steps down the aggregate basis of the property received to its aggregate fair market value. Think of it as the duplicated built-in loss is eliminated at the corporate level. So the corporation does not take carryover basis. They adjust that carryover basis down to the fair market value of the asset. My basis equals the fair market value. There is no built-in gain or loss. I've eliminated the loss. Now, the loss is still duplicated at the shareholder level, right? Because I apply the normal substitute basis rules. And we'll have a built-in loss there. The government is not going to eliminate all of the loss. They just don't want there to be two losses. Okay? So if I'm in the general rule, then I have to apply that at the corporate level. So it's one thing to say I need to step down the aggregate basis, but I have to do that by each asset, right? Because each asset I have to depreciate prospectively, and I need to know what that tax basis is. So how do I practically implement that basis reduction? I take that aggregate basis reduction among the contributed built-in loss assets in proportion to the built-in loss of each loss asset immediately before the contribution. So I only look at loss assets, and I do it in proportion to the total aggregate built-in loss. That's how I affect the step down in basis from pure carryover down to fair market value. Now, there is an election where the shareholder and the recipient corporation can elect for the shareholder to instead reduce its tax basis in the stock received down to fair market value, and allowing the corporation to take the general carryover basis and the built-in loss property received. So what that does is eliminate the duplicated built-in loss at the shareholder level. I still have it at the corporate level. So what the government is doing is giving me, if I have aggregate built-in loss property, I do not get to duplicate the losses. I can choose where I want to have the loss. If I do nothing, it's at the shareholder level, because I eliminated it at the corporate level by lowering the tax basis to fair market value, spread amongst the built-in loss assets. Alternatively, I can elect to not have that done at the corporate level and have the shareholder lower their basis in the stock received to the fair market value of the stock. Okay? So the government can just provide some flexibility in the parties determining where the loss resides, but I do not get to duplicate the loss. Okay. So let's work through that in a couple of examples here. So 813 is Jeremiah.
All right, so assume I'll transfer the building and land to a corporation in return for 50% of corporation stock, 50 shares. The property transferred to the corporation at the following fair market value, basis. And then it says no asset building loss. The fair market value of the 360 air stock I'll receive in the form of $275,000. Assuming the transfer meets the requirements under 351, what is Al's tax basis in 50 shares of 360 stock? 360 air stock received in exchange $200,000 in this case. The aggregate fair market value of the property transferred to the corporation exceeds the aggregate adjusted tax basis of the property. As a result, Al's tax basis in the stock is equal to aggregate adjusted tax basis of the property transferred.
So let me stop you there. So I had two assets going in. The threshold question as to whether I'm in the rules we just talked about is there on an aggregate basis built-in loss in all of the property? And there is not, because my fair market value is 275 and my adjusted tax basis is 200. So I actually have aggregate built-in gain. Normal rules apply. I duplicate the gain. I have it at the corporate level in the assets received, and I duplicate it at the shareholder level based on substituted basis. Now, don't get sidetracked in looking at each individual asset, because if I look at the building itself, it has a 75,000 fair market value and 100,000 adjusted basis. So that has a built-in loss on its own. But the land more than compensates for that because it has a fair market value of 200 and a adjusted basis of 100, so it has a built-in gain. We do this on an aggregate basis. Okay? If I was only contributing the building, then I would be in the rules we talked about. But the fact that I give two assets here and one has a gain that's larger than the loss, the government lets me do this on an aggregate basis. Okay? So the answer Jeremiah just went through is it's asking what is Al's tax basis on the stock received? What is the shareholder level's basis in the stock received? That's a substituted basis. I substitute my basis of 200 in the assets I contributed or my basis in the stock received. That's 200,000.
What are the adjusted tax bases of the building and land held by 260 Air? The building has a carryover basis of 100,000 and the land has a carryover basis of 100,000. Because the aggregate fair market value of the assets transferred to the corporation exceeds the aggregate adjusted tax basis of the property. 260 Air applies the general basis carryover rules. The building retains its built-in loss of 25,000 at the corporate level.
So because I'm aggregate built-in gain, I just take the general rule and I carry over the basis at the corporate level of 100 and 100. Doesn't matter that I actually have duplicated the loss in the building. That doesn't matter because it's overall aggregate built-in gain. Okay. So this is just an example of the general rule that if I have multiple assets, I test at the aggregate level. If I'm built-in gain, then I apply the general rules of carryover basis at the corporate level, substitute basis at the shareholder level, and done. Okay. As you can imagine, 813, the second part of 813. Anybody volunteer for this? I didn't work before class. Go on out. You can imagine this one's going to show us we're in the rule.
So given all that information, the fair market value of the 360 Air stock I received was $275,000 in the exchange. Assuming the transfer meets requirements under 351, what is Al's tax basis in the 50 shares of 360 Air stock he receives at the exchange? That would be $300,000 because in this case, the aggregate adjusted tax basis of the property transferred to the corporation exceeds the aggregate fair market value of the property. And assuming he doesn't elect to reduce his stock basis to fair market value, Al's tax basis of the stock received will equal the adjusted basis of the assets transferred. The general rule being that shareholder takes substituted tax basis and stock received.
Yeah, so I do have an aggregate built-in loss because my total basis is 300 and the value is only 275. But I'm in the special rules now, so I prevent the duplicated losses, but I replicate it at the shareholder level.
Continuing on that, corporations, a step down in tax basis and assets received. So what is the adjusted tax basis of the building and land? Aggregate adjusted tax basis of $275,000 because the aggregate fair market value of the property transferred to the corporation is less than the aggregate adjusted tax basis of the property. 360 Air must reduce the aggregate adjusted tax basis of the property to their aggregate fair market value. The allocation is made to those assets of built-in loss. So here will be only the building. Meanwhile, the adjusted tax basis of the building will be reduced to $175,000, which would be $200,000 minus $25,000 built-in loss. The adjusted tax basis of the land will retain its carryover basis of $100,000. This adjustment eliminates a net $25,000 built-in loss at the corporate level.
So again, this is the general rule, eliminates the duplication, but it does so at the corporate level. By taking down, it looks at only the built-in loss assets. I only have one, so it's really simple. I need to come down by 25,000, so I take down the building from 200,000 to 175. And that makes my aggregate built-in gain and loss be zero. Sure. Right? Or at the corporate level. Okay, now what if we don't like that answer and we want to do something different?
Don't like that answer. Well, the shareholder steps down the tax basis and stock received, and the corporation takes a carryover basis instead. So, what alternative election can Al increase the area with respect to those basic election rules? Al and the corporation can jointly elect to have and reduce the stock basis to its fair market value of $275,000. The corporation will take a carryover basis of $200,000 in the building and a carryover basis of $100,000 in the land.
This just means I can flip the general rule and take the step down at the shareholder level versus the corporate level. Still getting the loss somewhere, but not both places. And so you might ask yourself, why would I care about this election or not? Well, think what happens. So this is important when we talk about the acquisition stuff we're going to talk about momentarily. Where is the basis most beneficial, right? If I have basis in business assets, I can depreciate those, as you know, right? So I might want to have more basis at the corporate level, right? Because I can depreciate it and lower my taxable income. Basis at the shareholder level in stock, not depreciable, right? I never depreciate my basis in stock. It's only relevant if I sell the stock or if the stock goes worthless. So I would be trading current benefit of annual depreciation, lowering taxable income versus some, future possible benefit if I ever dispose of the stock. So I might want to make the election. I would probably, if Al was not going to tell me I'm going to sell this stock anytime soon, I would make the election and have Al suffer a lower basis in the stock, keep the higher basis inside the corporation. Okay. All right. Thank you. Okay. So that's our 351 stuff, transfers to a corporation. So again, I'm going to take you on like this timeline. So where a corporation has been formed, up and running. Obviously, it can be an existing corporation and we drop additional assets in, but it's more of the formation stuff. So now let's think like we're in the corporation's up and running, doing business for a number of years. We might do an acquisition, okay? This area of tax law is often referred to as M&A. For those of you that don't know, that's mergers and acquisitions. It's a very broad area, okay? Mergers are a term of art that you hear investment bankers and business people toss around, but that's not a technical term. One of the things we're going to talk about is a tax term that's called a merger. Okay? A merger can either be taxable or non-taxable. We're going to walk through why that can be. So don't let what the CEO says on CNBC as being any indication of the tax ramifications of the transaction. Okay? And what people call it is not what the transaction is for tax purposes. Okay? So at some point in the life of a successful business, its owners may consider expansion. You can grow internally. Many times that's called greenfield. Like think of planting something and it growing. It's you doing it, right? You can expand into a new division. You can expand into a new geography. And you can do that internal, right? You can just start your business and start your research and your development of a new product. You can do that. Some companies are extremely good at that. Companies are also good at expanding into other locations, right? So that's your greenfield expansion. There's nothing too earth-shattering about the tax implications of doing that. If you're expanding to new geographies, we just covered that in Advanced International. We're talking about that, which is now I'm introducing a new element of taxation that might raise or lower my effective tax rate globally. So I have to think about that, but that's just really an existing business deploying its assets to grow, right? Alternatively, you can grow externally. That's usually by acquisition, okay? And that might be, you don't want to wait around. It's too difficult for you to wait a number of years for your greenfield operation to be successful in this new line of business or in this new geography. So instead, you're going to jump to the front of the line. You're going to buy something that already is creating value, right? So if I want to expand and I have excess cash or capital to deploy, I can change my business just like that. Not as easy just like that, but almost. The CFO might think it's as easy as that, but buying something, right? I can buy assets, I can buy stock of another business that does exactly what I want it to do, right? Either from a division growth or from a geography perspective. Okay? So that's often referred to as M&A. So we're gonna explore in this material alternatives for how that can be pursued. Right? We're not gonna talk about greenfield, we're gonna talk about external acquisitions. The buyer and the seller, yes.
Does this apply to joint ventures as well?
Yes, yeah, so joint ventures I would count as this as well. So that might not be an acquisition per se, but I am deploying assets in a new operation and I'm using a third party to help me do that, right? If I'm doing 100% acquisition, then it's all on me to run that new business. Now, I may want some of the management of the target company to stay on. That's part of what I'm buying, is I want that expertise. I would choose to do this via joint venture. Now, the other thing I will caution you, just like merger is a generic term, joint venture is a generic term. That is not a tax technical term. So you might hear a business leader say, we're doing a joint venture. I would say, that sounds great, but how is the transaction structured? That's what I want to know. That's what the lawyers would want to know. That's what the tax people want to know, is how is the operation coming together? I'm going to try to pull back the curtain a little bit and talk to you about that, because it's going to depend on two things: the legal form of the transaction and the form of consideration that's exchanged. That will drive the tax implications of the transaction. Okay? And now, the tax people in the M&A transaction may be able to guide the parties to what they want. If somebody wants a non-taxable transaction, I might start leading them down that path. But if they want only certain types of consideration, big problem being cash, I cannot make a transaction where the seller receives cash to be non-taxable. You have sold something, that will be taxable. Okay? Remember all the boot transactions we're dealing with? A lot of that's cash in those examples that causes gain, right? So you can, tax person can only do so much within the confines of the business transaction at hand. Okay? So the legal form of the transaction and the considerations selected by the buyer and seller dictate the respective tax implications of the transaction. So when they start negotiating a deal at the highest levels, that's why tax people need to get involved sooner rather than later. And savvy M&A companies involve their tax advisors early in transactions. Because what you can't have is decisions being made that you can't go back and revisit. Because that will start cutting down avenues that you could otherwise explore from a tax perspective. So my clients that were really good at M&A, I was always involved, not me, my firm was always involved early in the transaction, before decisions were made in concrete that you couldn't change. Okay? Many times you run into a buyer and seller who desire different legal forms of the acquisition and consideration, which necessitates negotiation amongst the parties. So I view one of the roles from an investment banker perspective is to be matchmaker, to find a buyer and a seller, right? Here, let's come together and let's make this deal. The other thing that they perform is when there are disagreements on the structure of the transaction, right? We want to do the transaction, but man, they want stock, this party wants cash. How do you negotiate amongst that? And that's, tax people don't do that. Accounting firms don't do that, right? That's the deal makers, the investment makers, which will help do that. But once a deal is struck, my experience has been then the tax people take over, the tax and legal people take over the structuring of the transaction. Because you have to do it a certain way or you're not going to get the results that you want. And that's not the investment bankers doing that. That's the law firm who is papering the transaction in conjunction with the tax advisor. And usually, even with a firm, a company, buyer or seller, who has a strong tax department and tax leadership within their organization, so their own employees, they are certainly involved, but they reach out and they have advisors on these things. Because these things can be billions of dollars, and whether a transaction is taxable or not, a lot of ramifications. So there could be multiple law firms involved, multiple accounting firms involved. The clients that I've seen do that, it's because they want multiple people telling them the same answer. If you do this, this is your tax rebate, right? And again, they're spreading the risk because they have, I have 2 large accounting firms, 2 large law firms telling me all the same thing. I feel pretty comfortable in what I'm doing. And again, think about these transactions are not necessarily just even on the domestic scale, but they can be on a global scale. So you got lots of jurisdictions, lots of laws to deal with. This is why I think this is one of the more attractive areas of business in general, both from an advising standpoint, investment banking standpoint, a tax standpoint, a legal standpoint. Because these things are not easy to do. When I would be involved in one of these transactions from the very start, when we brought in early until closing, and then after closing, there's a bunch of stuff that goes on after that because you're integrating the businesses, right? All the synergies that the business deal model and the business leaders have been counting on, the stuff that's supposed to help pay for the deal, you have to execute that after the transaction. So it would not be uncommon between the first time you get involved until the end of the post-acquisition integration stuff. It could be a year and a half, 2 years. You've got regulatory things that have to go on along there, shareholder votes, financing, all that stuff has to be done. So these are incredibly costly transactions. They're extremely rewarding for professionals, both internal to these organizations and external, because I always view them as their life events, right? CEOs are betting their careers on these things. If you're going to spend millions of dollars, this thing has to work. If it fails, many people have lost their jobs because they overpaid on things, or it just wasn't a cultural fit, or the transaction just didn't work for some particular reason. So, very interesting area of work that you guys can pursue. Okay, so the corporate acquisition of a business can be structured as either a stock or an asset deal. Okay, that's like one of the first forks in the road is what's for sale from the seller's perspective, and what do you want to buy from the buyer's perspective, right? And that could be one of the points of contention between the parties. One party wants to sell assets, one party wants to buy stock, or vice versa. Again, that's the deal makers trying to bridge that gap between them. And the transaction can be structured either as being taxable or non-taxable. Okay? And you might think, well, why wouldn't we want to do non-taxable? I wouldn't want to pay tax. But if the consideration is driving it to be taxable because cash is what the transaction is structured for, that doesn't make the transaction bad. It just means somebody's paying tax. You got to make sure everybody knows that, right? But it's not like, only non-taxable transactions are the best transactions. Part of it is governed by the form of the transaction and the consideration. So you end up with 4 possible M&A scenarios, right? I can have the taxable acquisition of stock. I can have I'll start from number 1. I can have a taxable acquisition of assets. I can have a taxable acquisition of stock. I can have a non-taxable acquisition of assets or a non-taxable acquisition of stock. Broad categories, there's details and all of that. We're going to tumble through all 4 of these. But I would offer any M&A transaction largely falls in one of those 4 buckets. Right? You have 2 variables on each side, and you can get 4 possible permutations. There are many variations and nuances in these complex acquisition structures. Tax experts in the acquisition field use a variety of tools and alternatives to achieve the tax and non-tax objectives of the buyer and seller. Expertise in this area requires time and effort for young professionals to become conversant and effective in this area. So, if you get involved in the transactional part of a business, there's a learning curve. Lots of things. So you're going to be buried in the minutia of the particular transaction you get put on, and you might see one slice of one of these types of transactions, but you're not seeing the full field. you haven't been on one of those other transactions. So it's just a area that you gotta spend a lot of time and effort on this. My time at PwC, it was always, there were lead partners in particular areas of their expertise, supported by the national office. Because the national office was scrubbing all of the major tax technical issues, because ultimately, what we were responsible for is the structuring of the transaction. There's PowerPoint, so you can see why I love PowerPoint. But that's how we conveyed the transaction. Here's two companies, and I'm gonna do in 100 pages, I'm gonna show you how they become one. Up to closing, and then after that, we're gonna show some structuring to integrate all the businesses as well. That might be in 100-page slide deck, right? The attorneys are working right with you because they have to paper all that. Once everybody agrees, this is the steps that we're gonna do to accomplish the result. And then the national offices were involved because you would ultimately write an opinion on the taxability or non-taxability of the transaction. And that's what the client is paying for. Structure the transaction, help me implement it, right? Because you can't flip a 100-page slide deck at somebody and say, here, hey, good luck, let me know how it goes. Typically, they want you to provide the project management as well and be right there working with them, part of the larger team, writing the transaction. So I had people that was in my group that were very adept at project management. And I always view that as it's herding the cats. Like you have a weekly call, here's the things we're gonna do the next week, and you're doing this, you're doing that, you're doing that, and then we're gonna get together in a week. Did you do that? Did you do that? Did you do that? If not, we're falling behind. How can we help that, get that done? What are our problems? But being very objective about it, just marshaling the troops, getting it going. And those people can be very marketable because it's really hard to get a large organization to actually implement something. You got treasury, you got legal, you got HR when you're bringing new people in, you got different HR policies, you got treasury functions are different. All that stuff has to come together. Tax is a piece of that. And I have found that tax people are driving a large part of the work plan because, again, the steps have to be done in a certain manner, in sequence, or you're not going to get the tax result that you think. And meanwhile, all the IT group have their own work plan, right? Because they're trying to merge the IT systems, right? That's a big deal. And that has to do with tax, but that has to be done as well. So these are massive undertakings by businesses. And they may have more than one going on at the same time, right? There are different stages. So it's constantly a moving target. Okay. So let's start with the first category, taxable acquisition of assets. So taxable acquisitions of another business, whether structured as an asset or stock purchase, most commonly arise when cash is used in as consideration. Right? Again, I can't take an asset and exchange it and get cash back and hope not to pay tax on it. The tax code is just not written that way, right? I've sufficiently separated myself from the asset. I no longer have that indirect type ownership to the asset because whoever bought it, just like an eBay transaction. Sell something on eBay, somebody's doing whatever they want to with it, you have a taxable event. Right? You sold it, you have cash. So why would that be the case? What if the seller only wants cash? You're going to have a taxable event. If the founder is trying to exit the business and wants cash because they're going to go to Europe and live the rest of their life, taxable. So structure the transaction, but just realize there's going to be tax paid on that transaction. So taxable acquisitions have the non-tax advantage of cutting off the seller's continued ownership and input toward the prospective operation of the business. Right? If I pay the founder cash for their business, assets or stock, they're gone. Right? They no longer get to come to the board meetings. They no longer get to vote stock. They no longer get to call me and say, "What are you doing with the business?" They're gone. I don't have to deal with them anymore. If I do a stock transaction with them, depending on how big they are, their target, compared to my acquiring business, how much ownership do they have in my business afterwards? Do they have a board seat? the person's still in the C-suite, right? Now, that may be a good thing. I may want the continued ownership. If the founder is not ready to retire yet, and I get 3 more years of them with an employment contract, that might be exactly one of the things I'm buying. Because I want that person to help me get that business into my business and help develop the rest of my business as it relates to their business, right? So it could be a certain fact pattern where I just want to exit the seller and I'm going to take this on now. I know my stuff and I'm going to do it the way I want to do it. Or it could be a fact pattern where no, I want that expertise. Now that becomes an issue where I want an employment contract that's enforceable. Right? I want that person to work for the next period of time. I want them to take off. So a non-tax advantage might be either cutting off that person's involvement in the future. A common non-tax disadvantage of acquiring a business in a taxable manner is the buyer's prospective cost of any debt required to raise any incremental cash needed to fund that cash acquisition. Right? Interest rates are going up right now. We got geopolitical things driving interest rate markets up because times of uncertainty, lenders want to be compensated for the time value of money, so they tend to raise interest rates. So the market rate of interest is going up. That is having a knock-on effect to the M&A market, right? Because buyers who are using cash, if they don't have it on hand, they got to go find it. How do they find it? They borrow it. If that's more costly, that's a non-tax. That's an economic cost of the transaction. To get the cash that I need to get to the seller who wants to sell for cash, I have to go raise the capital, and it might be more costly. That might lead me to where I might do a stock transaction because I don't have to raise the cash. From the acquiring corporation's perspective, taxable acquisitions of corporate assets provide a tax benefit through the step-up of tax basis in the acquired assets to the fair market value. Remember, when we buy assets, we step up their basis in the assets. Accounting does it, tax does it. When I buy stock, I step up the basis in the stock, not the underlying assets. Okay. From a buyer's perspective, I like to buy assets. From a prospective taxable income perspective, why? Because now I have a higher tax basis that I can depreciate and amortize going forward. So my subsequent depreciation of the stepped up tax basis in tangible and identifiable tangible, intangible assets compared to continuing the historical depreciation and amortization reduces the taxable income of the acquirer. If I buy stock, my general rule is my basis is in the stock. The assets inside the target corporation, I just keep doing what they've always been doing. So if they've already depreciated those assets, then I don't get any depreciation for that. My basis is stuck in the stock. Whereas if I went in and said, hey, why don't you sell me that division, those assets in that division, then I get to spread my purchase price to depreciable and amortizable assets. It's going to lower my prospective taxable income of the acquirer. A big one being subsequent amortization of acquired goodwill further lowers the taxable income of the acquirer. When I buy a collection of assets, then I spread the purchase price over the identifiable assets, tangible and intangible. Any excess purchase price is goodwill. The tax rules for purchased goodwill for the purchase of assets is straight line 15 years, right? And so that could be a significant number, right? Goodwill is, in that context, is the value of the collection of the assets is more than the assets themselves. Right? The whole is more than the parts. So that could be a very advantageous thing depending on that amount there. If I buy stock and I have the same goodwill, but it's not amortizable, I have to buy assets to be amortizable. All right.
People choose, corporations, they choose the asset basis over the stock acquisition because of the stock basis.
Yes.
Because the stock acquisition has, you inherit a lower.
Yes, because my basis is in the stock and stock's not depreciable, right? And then the corporation itself that owns the assets, target stock that I bought, just keeps on doing its same thing with its assets as a general matter.
Do you get to choose like which assets and liabilities you acquire?
You can, but you need a seller willing to sell you the assets. We'll talk in a moment how it's a disadvantage to the seller to sell you assets. So as a general matter, acquirer likes to acquire assets because I can step them up and depreciate them and amortize those in my future taxable income. Buyer dislikes that. So I like to think of M&A transactions is that's the natural tension and requires the negotiation. And what is one thing that can satisfy someone who is worse off? Increased purchase price, right? Seller might say, I don't want to sell you assets. And buyer says, I really want to buy assets. Seller can say, how much really do you want to buy these assets? Pay me more. Right? And now, then I'll talk in a moment about the disadvantage to the seller of selling. So you have these natural tensions between the two, which is kind of fascinating. And there's no rhyme or reason why one party wins versus the other. It could be negotiation power, who has, do you really want to sell? Do you really want to buy? And so, depending on that is, if somebody's on the fence whether they want to buy or sell, they may not be willing to negotiate.
So one of the issues with M&A is hidden liabilities. With the asset acquisition, you're able to avoid that, right?
Yeah, so that's a good point. So if you buy assets, you can choose, you can cherry, I like to think of it as cherry picking, which means you go in and you pick exactly what you want. You leave behind things you don't want. You typically don't want liabilities, right? I don't want your liabilities. I don't want your liabilities that I know about, and I don't want your liabilities that I don't know about. So known and unknown liabilities, I want to try to distance myself from them. If I buy stock in a corporation, everything in that corporation comes with it. All of the assets, which I may not want all of them, and all the liabilities in there come with it, and the unknown liabilities come with it. Big transaction that happened here 10 years ago, it's still going on, is Bayer, a German company, bought Monsanto, large St. Louis-based company, and the issues with the fertilizer, the insecticide that they use, Roundup. And so there's been an explosion of lawsuits over the last 10 years. So Bayer, I think every analyst would agree, overpaid for Monsanto. They paid like $63 billion or something, but the liabilities are massive. And so they bought stock from Monsanto. So this was a known liability because there were some Roundup cases out there, but it was unknown in the volume of cases that were to come. And so they're trying to settle all this and move on as a business, and it's just been a complete, the amount of effort that company has put on to try to manage that liability portfolio from a cost perspective, a legal perspective, and then all the payments that they've had to make, they never imagined that. But that was all because they bought the stock of the corporation. So you get whatever comes with that, it's now your problem. Okay, so from the target corporation's perspective, taxable sales of corporate assets create a potential tax disadvantage for the seller due to double taxation. The first is at the corporate level, right? If a corporation sells its assets, that's a taxable event, right? We pay tax at 21, it's a U.S. corporation. And if what happens to the after-tax proceeds, if the idea is to distribute those to the shareholders, you guys know shareholders pay tax on dividends, right? So that's 2 layers of taxation. So, Arthur, to your point, the buyer might come in and say, I want to buy assets. The seller probably is expecting that. The seller is going to say, well, that costs me X amount of tax because I'm going to pay tax at the corporate level, and then I'm going to distribute those after-tax proceeds to my shareholders because that's extra value in the corporation that they don't need. My shareholders are going to want a return on that. To them. So you need to compensate me for my 2 layers of taxation. If the buyer says, I don't want to compensate you for your 2 layers of taxation, then the seller can say, well, guess what's for sale? The stock. If the shareholder sells the stock, there's 1 layer of tax at the shareholder level on the gain or loss of the corporation stock. That's the natural tension that you face in an asset versus stock deal. And it could be negotiating power, who wants the deal more, will pay more and be more willing to negotiate. And the great equalizer is purchase price. So if you really, really want to buy assets, then you might have to pay more. Because the seller knows they're gonna incur some tax, so they want to be compensated. Okay, so let's do the 816. We're gonna show some of these here. So this is Hollis.
Assume SCR will purchase WB's assets for $300,000 and assumes that the company's liabilities are $35,000. WB will realize $335,000, which will allocate to each of the assets sold, which are listed. And the question is, what amount of gain or loss does WB recognize on the sale of the assets, and what is the character of the gain or loss? And the answer is WB recognizes total gain of $200,000 and then pays a corporate level of tax of $200,000 times 21%. And then the different characters are inventory is always ordinary, building is ordinary, land is part of the 1231, and then capital gain includes customer list and goodwill.
Yeah, so a couple of things here. So Arthur was asking about liability assumption here. So the transaction here is just structured as a the buyer is assuming some liabilities. They don't have to, right? They can say, I want to buy all of these assets and none of the liabilities, right? You're going to pay $335,000 for that. I will otherwise sell it to you for $300,000 if you take on $35,000 of liabilities. So you can think of that as that's a zero-sum game. Either I pay more for gross assets or I pay less for net assets, but that means I don't pay liabilities associated with the assets. And then, so now we got a purchase price allocation. So we take the $335 and we spread it amongst all of the identifiable assets. And my plug number here is goodwill, right? So I know I got cash of $10,000, receivables, inventory. I go through and I spread all that. I have excess purchase price over identifiable assets of $75,000. And then I compare that to my tax basis, and this is my corporate level tax. That's what the seller is going to be complaining about if you want to buy assets. They're going to be like, I got to pay tax of 21% of $200,000. You got to pay me more, right? Because I have to do that. And then the last part here is just showing you how that is spread amongst the assets and what the character is. So there is a corporate level event that has to be done when a corporation sells assets. Okay, thank you. Okay, the second part of 816 is you will.
So suppose that WB output control of expense by exchanging the 258,000 net amount realized after the tax. For such a WB stock, what amount of the gain or loss will seller recognize on the exchange of her WB stock for the after-tax proceeds from the sale? So first,
Okay, so let me push there, you go. So the first part that Hollis was doing is the corporate level event at the sale of assets, right? So the second part here is then what is the corporation going to do with the after corporate tax proceeds? I was posing to you earlier they could pay a dividend. They could pay a dividend. The other way they could do that is the corporation could liquidate, meaning that we're going to talk about that at the end of this chapter. But the corporation goes away. It basically distributes its balance sheet to its shareholders, and the corporation dissolves under state law. That's what's going on here. So they sold all their assets. There's nothing left in the corporation except the cash, and so they're going to liquidate the corporation. But that's taxable as well. So that's the second instance of taxation. The same thing that would have happened in a different form if they would have had a dividend and the corporation kept it going. Take us through that.
so seller recognize the long-term capital gain. So we use the 258,000 minus the 50,000. We got the 208,000, and now we calculate the shareholder level tax, and we use the 208,000 times 50%, and we got the 31,200.
Yeah, so the the liquidation to the shareholder, we haven't covered that yet, that's odd that they put this in here, but, when we get to it, you'll see it's amount realized, that's the value she receives, so she receives $258,000 from the corporation. She gets to recover her tax basis in the stock of $50,000, that's a $208,000 capital gain to her, and that's taxed at the preferential tax rates for individuals, 0, 15, or 20, she's in that 15% bracket, so that's that $31,000. Okay.
And the total tax paid using this form of aggregation is we used 42,000 and 31,200, and we got the 73,200.
So the 42 was from the prior example, here, this 42, right, that's the corporate level tax effect, and then she pays 31,200 at the shareholder level, that's the 2 layers of taxation that the seller is gonna complain about in this transaction.
So the last step, we calculate how much left after the tax, and we use the 300,000 minus the 42,000, and minus the 31,200, and we got the 206,800.
Yeah, so that's what they're gonna say at the end on the seller side is, yeah, you paid me 300, but I only kept 226,800 on that after tax. So I know I got a tax effect here. 2 layers. Okay. Do the last one.
So the author rules are attractive of Sanda. They still perceive the SCR with the maximum tax benefits. The building with have the increased tax base of 30,000. The customer list the goodwill will have a tax basis of the 25,000 and the 75,000 respectively, and the SCR can amortize this asset over 15 years on the streamline basis.
Yeah. This shows you, I put here, the competing interests of the buyer and seller. So it's bad for the seller because they have double taxation and lowers the after-tax cash that they get to keep. But on the buyer side, they get this stepped up in basis in the building to 30,000 and the customer list and goodwill to 25. That's because that's what happens here. This gain realized, that increases the basis because you bought that. So you're going to get the full basis of 80,000 there. And then the customer list and the goodwill are not even being amortized already because those are intangible assets, self-created. But if you purchase them, they become purchased assets and you can subsequently amortize those over 15 years. So good for the buyer, bad for the seller, right? And that doesn't mean that one side's going to get the win or not. It's going to be a negotiation position on both, and there might have to be some increased purchase price to get the seller to agree to the asset purchase. Okay, so goodwill, we talked about a little bit, but represents the difference between the fair market value of the business and the sum of the assets, some of the fair market values allocated to the identifiable assets. If you go back to that example, that's the plug number here. We went through and did our purchase price allocation for all of these assets. I still paid more than that. That's the collective value of these assets being put together and assuming they're going to continue in business. That's $75,000 in the purchase price allocation. So that is my goodwill. Goodwill calculation for tax purposes can differ from accounting, as accounting goes about it a little different way, but usually they're pretty close in number. So a book tax difference can arise given from the different starting points. If I have different amounts of goodwill for tax and book, that'll be a book tax difference. And they will certainly arise in the future because, we all know this from all the stuff we did in tax accounting and the midterm, goodwill is not amortized for book purposes. Subject to periodic impairment testing, right? Is this business worth what I paid for it in subsequent balance sheet dates? I.e., is the goodwill still worth $75,000? It can go up. I never have an impairment. But if it starts going down, I might have to impair that $75,000 goodwill. That's the book treatment, right? It's a periodic testing on the balance sheet. Acquired goodwill is amortizable for tax purposes over 15 years on a straight line basis. Again, why buying assets is a good answer, because I can acquire that asset and start amortizing that against the acquiring company's tax bill.
So if the seller, like you mentioned before, the seller may like ask for more money for the increased purchase price, does that increased purchase price go into goodwill?
Yes. Yeah, assuming you had these identifiable assets were set, then everything would just fall to goodwill at the end of the day. And that's exactly what it's supposed to measure, right? Because you had an arm's length transaction between unrelated buyer and seller, and they negotiated the purchase price. That's what happens, right? I won't sell it for that. You sell it for this. Yes, now we have a deal. And that would, dollar for dollar, that would fall to the goodwill line. And the buyer knows that I do get to recover that goodwill. So if it goes up dollar for dollar, well, I'm going to get it back through taxable income over 15 years. So maybe I factor that into my analysis as well. Okay, so let's compare and contrast that. So that was assets. So taxable acquisition of assets. That was our first category of our 4 possible M&A permutations. So the issue there is always the push and pull between the buyer and seller. Asset purchased good, general matter for buyer, costly for seller. Stock, less costly for seller, more costly for buyer because my basis is caught up in the stock, not the assets. Okay, so now we're on taxable acquisitions of stock. From the acquirer's perspective, when the stock of a target corporation is acquired in a taxable transaction, the corporation retains its tax and legal identity, right? All it does is there's a new owner. I like to think of the box just moves over underneath my acquiring company. You bought stock. There is no change to the depreciation and amortization schedules for the assets of the target corporation. The only thing that happened was the stock changed hands. No different than if I go out and buy Apple stock this morning and I sell it tomorrow, right? Apple, nothing changes inside the corporation just because their shares change hands. Whenever you buy Target stock, if you buy 100% of it, which we'll talk about in a moment, nothing changes from the inside the corporation from an asset depreciation and amortization. Okay. From the target corporation's perspective, the target corporation is not impacted when its stock is sold. It's a shareholder level thing. That's why the seller's tax implications, I don't have double taxation. It's not a corporate level event. It's only a shareholder event. That's why the seller might say, stock is for sale. It has the side effect that it's not good for the buyer. From the target shareholder's perspective, a sale of target stock by an individual shareholder avoids the potential double taxation we just talked about associated with a corporate asset sale and may qualify for the preferential capital gains treatment available to individuals. So that second instance that we were going through where it was a liquidation, but that was the second instance of taxation. That was taxed preferentially because that was a capital gain transaction. If instead the transaction was not an asset sale followed by a liquidation, it was just a straight stock sale by the seller, that seller would have, just like my Apple example from purchasing today and selling tomorrow, that would be a capital gain transaction. Right? And mine would not be preferentially, remember, you only get preferential treatment for long-term capital gains. In a general exit scenario, that likely is a long-term capital gain for shareholders. Okay, let's do stock in 17. This is Jada.
Suppose instead that SCR purchases a WB stock from Standard for $300,000. What amount gain or loss does WB recognize in this transaction? The WB will not recognize gain on this form of acquisition because it has not sold any assets directly to us.
So this is really important. I'm big with pictures. So it might help you on an exam, because that's the first time you're going to see this before you start working. Draw the picture. What is the transaction? Draw the parties out. The question here was what happens to WB? Well, when you draw it out, WB just had their stock sold. They didn't do anything, right? There was no corporate transaction. So there would be no tax. So remember when I was also saying, look back at the question, did I answer the question that was posed? Like, which party was I talking about? Make sure you hone in on that. Don't just start answering a different question than the one that was posed.
What amount and character gain or loss is SATA recognized in this transaction? The SATA recognizes long-term capital gain of $250,000, which is $300,000 minus the $50,000 stock basis, and pays the shareholder noble tax of $37,500, which is $250,000 minus the preferential tax of 50%. SATA will be left with $262,500 after taxes, which is $200,000 minus $37,500, which is $35,700 more than a direct asset sale. $262,500 minus.
So that $35,700 was in the earlier example. That was because there was less proceeds that went to her because I had to first pay the corporate level tax on the asset transaction. Stock transaction, nothing happens. We answered that first part. Nothing happens to start the corporation. So you get paid. You get more proceeds at the end of the day from that perspective. But I still pay tax at the preferential tax rate.
Although attractive to SATA, this deal will not be as attractive from a tax perspective as a direct asset sale to SCR. Rather than $80,000, the building will retain its adjusted tax basis of $50,000. In addition, the customer list and goodwill will have a zero tax basis of WB because they are self-created assets. The adjusted tax basis of WB's other assets will remain at $135,000. SCR has a tax basis in the WB stock equal to the purchase price of $300,000.
Yeah, so that's just showing you again the push and pull between the buyer and seller. This time in terms of the stock transaction. Better for better for seller. She has one layer of tax, right? More after tax cash at the end of the day. Bad for buyer because I don't get any step up in the assets, including those last two assets, which were not already amortizable because they were self-created. Right? So Jeremiah's question, if goodwill was a big number, there's a vast difference in the future tax consequences to the acquirer if that goodwill is amortizable or not. Okay, perfect. So I put down here in the box that $300,000, since stock is a non-depreciable asset, the purchaser's basis of the stock is really not a relevant tax attribute. It's not amortizable. It only becomes relevant in a future sale or disposition of the stock, right? Which might be never. Right? If I buy it and I'm never going to get rid of the company, my basis is hung up in that stock, and I never get the benefit of that basis. So that's what the buyer of stock might say. Is like, well, that's terrible for me. All my basis is hung up in the stock, and I don't get to amortize that. Well, that's when you can see the negotiation that would happen. Well, let's go back to that other one, and I'll tell you how much this costs me as the seller. Double taxation. If I sell you assets, how much more are you willing to pay? And we get to a happy medium there, where it's more costly for me, but you're compensating. Okay, the last topic for today is a 338 election. Okay? This is taxable acquisitions of stock. We're still talking about. So the legal transaction is a stock sale. Okay? Just think if you could get the best of both worlds. What if the seller could be treated as selling stock, resulting in a single instance of taxation, often at preferential tax rates for an individual, while the buyer is nonetheless treated as purchasing assets, allowing for that stepped up tax basis for future depreciation and amortization. 338 provides exactly this outcome. It's an election. It's not as powerful as what you might think, especially in a domestic context. But it is the tax fiction, okay? It's a tax election, so it only has effect for tax purposes. So when you talk to legal people, it doesn't have any effect for legal, accounting, treasury, any of those stakeholders, irrelevant. Buying stock. We're going to make a 338 election, which would change that stock transaction to an asset transaction. It does not affect the legal form, which remains a stock sale, but we treat it as an asset sale for 338 purposes. So there must be a qualifying stock purchase, a QSP is what practitioners call it, in order for you to be eligible to even make the election. QSP only occurs when I have a corporate purchaser of corporate stock. So I can't have an individual being the seller or the buyer here. I have to have a corporate purchaser of corporate stock, and that corporate purchaser has to acquire at least 80% of the target corporation within a 12-month period. So that's called the acquisition period. So what that means is I can have, instead of one fell swoop, if I buy 100% of it, corporation buys 100% of a target corporation, I have a QSP. But if I buy 75% and then I buy 10% within a 12-month period, I also have a QSP because I served the 80%. So I like to think of it as kind of like creeping ownership. I can buy it over time as long as that's within a 12-month period. I can count everything in there. While the election is technically solely the discretion of the buyer, it is commonly addressed in the purchase contract because the election can impact the seller's tax computations. So it's the 338 election on its own is the buyer's election, but a well-advised seller will know that it's a unilateral election on the buyer, and they can make the buyer have to get their permission as a condition of their contract. So you cannot make the election until you have my consent. And the reason they do that is because it changes the seller's implications on this transaction. So the reason this is not as beneficial as you would think, because suppose it is getting the best of both worlds, seller treated as selling stock, buyer treated as buying assets, is because the corporate level asset sale, the fiction of there being an asset transaction in a 338 election, increases the current income tax that renders the election economically unattractive, given the tax benefits come in the form of increased future depreciation and amortization deductions for the buyer, right? All the good things we saw in an asset, taxable asset acquisition for a buyer is there, but it comes at the cost of current tax to the seller. The seller has to, that corporation, that fiction of the asset sale has an asset sale. So, the rare instances where a 338 election makes sense is when the target corporation is a foreign corporation for which the deemed corporate asset sale has no consequence since the foreign corporation is not subject to U.S. taxation. So in an international context, if I buy stock, and it's a QSP, I can make the election treated as if I bought assets. Why? That's good, because I can step up the assets and amortize the assets on this new stepped up value, including, like in those examples, customer lists and goodwill that are not even amortizable if they're self-created. I said the seller has a negative impact here because they have an asset sale. Well, my seller here is a foreign corporation. If I'm buying a foreign target, entities are not subject to U.S. tax. It's a foreign business, it's not subject to foreign tax, right? We don't have jurisdiction over that entity. So the knock-on effect of the 338 election is there, but it has no practical U.S. tax effect because the taxpayer is not subject to U.S. tax. So that's one example where a 338 election can be beneficial. Nearly every U.S. company that buys a foreign target corporation will make a 338. The second instance, which is rare, is when a U.S. target corporation has carry forward losses that can offset the corporate level gain. So what if the what if the U.S. target corporation, so now we're back to the domestic context, looking at buying the stock of a U.S. target corporation in a QSP. I'm going to buy, say, 100% day one. Qualified stock purchase, I got a corporate purchaser of U.S. corporate stock. I decide to make the 338 election. It's going to be a corporate level gain on the deemed asset sale. But what if that corporation had net operating losses in it? Say it was a startup that had lost money for a period of years. Remember, net operating losses for a corporation carry forward indefinitely. I can utilize those losses against a corporate level gain on an asset disposition. I can only offset 80% of the gain. Remember back to our NOL carry forward rules. For recent NOLs, they can recently created NOLs, they can only offset 80% of future taxable income. So I can mitigate the base on which the foreign tax, up to 80% of the gain with a loss depending on the magnitude of the foreign loss. But that may be a way that I can acquire a startup company that gives the buyer step up in all those assets that they want to amortize, including